This is one part of a 5-part series. At the end will be a link so you can watch the rest of the series, as well as a link to my calendar to schedule a free 30-minute consultation where I'll personally be able to go over a review to see what your options are. You don't have to be rich to get started, just start with where you are today. There's a misconception out there that you have to have a large sum of funds in order to get started with your own banking system, but that's not true at all. We can start today by using the monthly disposable income that you might currently be putting towards savings or putting towards trying to get out of debt. Make sure you like, comment, and subscribe, and don't forget to ring the bell so that way you'll be notified when I post new videos just like this every week. If you ever served the armed forces, you know never volunteer. If you did serve, thank you and God bless you for serving our country. We're not talking about tax loopholes or deferring taxes or avoiding taxes. We're talking about not volunteering to pay more. This is something that the majority of Americans are doing and they don't even realize it. So let me ask you a question. Since we know that the federal government is trillions and trillions of dollars in debt, so in the future, where do you think they're going to get the money to pay for all this? If you said taxes, you're right. So do you think taxes are going to go up, down, or do you think they're going to stay the same? Well, if you think taxes are going to be higher in the future, you're not alone. So is postponing taxes really a good idea? Think about it. If you think taxes are going to go up, why in the world would we want to keep putting more money than what we're already putting into something like a 401k or an IRA? So when do you think would be a good idea to start planning to pay less in taxes? I know some of you are saying 10 or 20 years ago would be a good idea, and that's what we should have done. But it's like they say, the best time to plant a tree is 20 years ago, and the second best time is today. Tell me if this sounds like the government's plan for your 401k. You put up all the money, you take all the risks, you manage it on an ongoing basis or pay someone to manage it for you, and then in 30 years or so, Uncle Sam tells you how much you owe them. Now, I'm not going to give you tax advice, but go ask your CPA or tax attorney what happens if you want to take money out of your retirement account before you're 59 and a half, or you want to keep it in there after you're 70 and a half. How much will be left after taxes and any fees or penalties? Ask them if by you investing in a qualified retirement account that you volunteered to give the government some type of control or right to tell you what you can use your money for, when you can use it, when you can take it out, or when you can't, without getting penalized, oh yeah, and you still have to pay taxes. So let me ask you a few questions. Can the federal government change the tax laws? Yeah. Can they do it whenever they want? Yeah. They are the ones who decide how much or when those laws change, not you, right? So doesn't it make sense that you put your financial future into something that you control rather than the federal government? If you haven't thought so already, you're probably thinking, this seems just too good to be true. Is this some kind of scam? Is this really legal? Does the federal government know what we're up to? Of course they are. As a matter of fact, the government has been aware of this for over 100 years, and the TAMRA Act of 1988 not only acknowledged it, but further defined how this can be used inside a high cash value whole life insurance policy. Now, this is not like Grandma and Grandpa's whole life insurance policy, and don't waste your time asking the people who did your car and homeowners insurance about this type of service, because they're going to have no clue what you're talking about. This is a very specially designed policy where you'll have cash value on day one. And you can receive funds anytime that you have cash value within 24 to 48 hours deposited right into the account of your choice. Now, wait a minute. Whole life insurance, you might be asking? I've always heard to buy term and invest the difference. Haven't you? So how's that strategy been working for people in the last 20 to 30 years? Now, don't get me wrong, because back in the 80s when every single person who was throwing money in the stock market was making a killing, A.L. Williams, as well as others, made a pretty compelling story as to why this was the way to go until 1987 when the market crashed. And I'm not against term insurance if it's for the right reasons. As a licensed insurance agent in multiple states, I have helped literally hundreds upon hundreds of people with term insurance policies. And I'll bet not a single one of them ever invested the difference. Have you? Term is super cheap if you're young and healthy, but it has zero cash value no matter what age you are. It's like renting versus owning. Do you want to know why insurance companies like to brag about how cheap term insurance is and promote it so much? It's because term insurance is almost all profit. They only pay a death benefit on maybe 1 out of 100 policies. Most people either outlive the term or cancel the policy. And they about have a stroke when they see how the premiums go through the roof when they get to the end of that term. And God forbid you run into a financial pinch, your policy lapses, and then you get into an accident or something happens to your health, because you might not be eligible to ever get insurance again. If you had a banking policy, on the other hand, you wouldn't have to worry about the premiums. Heck, you wouldn't have to worry about some of your other bills because you'd be able to take cash value from your policy to pay the loans or to make an investment or to replace your income until you're back on your feet. The 4 largest banks in the U.S. use whole life insurance policies as a storage facility to hold and grow their money. So if it's good for banks that already have millions in real estate and other assets, what does that mean for you and me? Wells Fargo has twice as much in whole life insurance policies than they do in all of their bank locations. Bank of America has more in whole life insurance policies than what they spent building over 5,000 plus branches all across the United States. So now that we know that banks, government officials, as well as many Fortune 500 companies utilize this system, let's take a look and see why it would be advantageous for the federal government to be behind 401k and other qualified retirement accounts. Now let's say we had a 401k, they got a 10% rate of return, and you put $5,000 into it, and you're at a 20% tax bracket. The rule of 72 says that your money will double every 7.2 years at a 10% interest rate. So we can see that $5,000 turning into $10,000, then into $20,000, and then $40,000. Now, when someone first showed this next part to me, I didn't believe them, and I've even been in a seminar with over 400 people there where the speaker said the same thing. He said he had to call his CPA because he didn't believe the math. I was always told that putting off paying taxes is better because the principal is growing tax deferred. Since that's what I was told, and everyone I knew back then was doing it, I just followed along and never bothered doing the math myself. If you invest that $5,000 and defer or procrastinate on paying the $1,000 in taxes when you're, say, 45 in this example, then when you're 66 and on a fixed retirement income, you'll have to pay $8,000 at a 20% tax rate. But wait, let's look at this both ways and see if what I was told was true. So if I decided to put that $1,000 in tax liability and put it into an investment at the same 10% rate, at retirement, I'll have $8,000. So let me ask you a question. Where is the tax saving by deferring the interest? Now, I understand we all like tax deductions, right? But remember the saying, a stitch in time saves 9? Well, think of it this way. Let's say you had a tax deduction last year for $1,000. Where is that money today? What'd you do with it? You probably spent it like most people. So if it's been less than a year ago and you can't put your hands on that $1,000 today, where are you going to find $8,000 to pay Uncle Sam when you wanted to retire? If you're like most Americans, it's going to come right out of your life savings that was supposed to be for retirement. So where do you see yourself spending more in taxes? $1,000 or $8,000? So is procrastinating paying $1,000 when you're 45, working full-time, really better for you than paying $8,000 when you're 66 and on a fixed income? And again, we're assuming that in over 20 years, taxes don't go up. By the way, some people either forget or don't understand that if you have, say, $100,000 in your 401k, you really don't have $100,000. Depending on your tax bracket, you might be handing over 20 or 30 G's to the federal government, depending on what your tax rate is at retirement. With infinite family banking, you don't pay taxes on the growth of this money ever. And there are two reasons why. Number one, life insurance death benefits are always 100% tax-free, even on the cash value and all the funds accumulated in your banking policy. That includes dividends as well. Number two, when you receive funds from your policy, while you're alive, you aren't actually taking the cash value out of the policy. You're using OPM, other people's money, just like banks do. In this case, you're using the insurance company's money. You're taking a loan from the insurance company, and the insurance company is using the cash value that's in your policy as collateral. So if you were to pass away while you had an outstanding loan, there would be no debt that would go to your family. So let's say you're in your 60s, 70s, or 80s, and you and your spouse want to remodel your home, go on a vacation, and buy a new car. Maybe buy something for the grandkids. And you die with that outstanding loan not paid back. That debt doesn't go on to your spouse. Now, that's not the case if you were to take a home equity loan. If you take out a line of credit using your home as collateral and you die before that loan is paid off, there's going to be a lien against the property that your spouse is going to be responsible for paying all the principal plus interest. So when you're the banker, you're the one that's in control. You're the one that decides when you want to pay it back or if you want to pay it back at all. Remember, this is your money, and you're the banker. If you pay it back, there'll just be a greater death benefit that will go to your estate if you want to create a legacy. If not, enjoy your retirement and spend the money on the people and the things or causes that matter to you the most. This is why it's such a perfect vehicle for storing and growing funds. Your policy grows with guaranteed rates of compound interest plus dividends. The carriers we use are all over 100 years old and all have paid dividends in addition to the illustrations we show you for over 100 years. Any loans you choose to take don't show up on a credit report, and as we mentioned earlier, if you die while you have an outstanding loan, the balance will be paid off using the excess cash value in your policy. Many people utilize this as a way to borrow money for the rest of their lives, paying themselves back the interest, giving that dollar more than one job, and at retirement, they can take as much of the cash value for tax-free retirement income by way of loans and never have to worry about paying it back. Any available cash value that they didn't take loans against, along with the death benefit, go tax-free to their estate or beneficiaries of their choice. Click the link in the description below. There you'll be able to have access to my calendar and be able to have a free 30-minute consultation with me where I'll personally look at your situation and see how the infinite banking concept can benefit you reach all of your financial goals and dreams. By clicking the links on the screen, you'll be able to watch either the full webinar or the next video in this series. Don't forget to subscribe, like, and of course ring the bell so that way you'll be notified once I upload new videos just like this one every week. Thanks, God bless, and have a great day.